$20,000 can disappear in a week, not in a scam email, not in a decades-long bear market. In 7 days, Terra fell from $80 to $42 to $18 to pennies. People who thought they were earning a safe 20% yield watched house down payments vanish. Here's the blunt truth. For most people, crypto is not an investment. It is a volatility machine that shifts money from the impatient to the disciplined and sometimes to insiders. In the next few minutes, you'll see why millions of coins have already died, what a 70% drawdown does to your life, and a simple test to decide whether crypto deserves even 5% of your money. Let's make this real. Mike is 32. He has $15,000 saved after years of skipping vacations, driving an old Honda, and turning down dinners out. That money is his emergency fund and the start of a future down payment. Then he sees Terra influencers call it stable. YouTube thumbnails promise passive income. His group chat fills with screenshots showing 5-figure gains in weeks. Mike moves the $15,000 in. For a while, it works. The app shows green. He feels smart. Maybe this is how you catch up in a world where houses feel out of reach. Then Monday hits before work. He refreshes his phone. $15,000 becomes $11,400. By lunch, it's $7,800. By Wednesday, under $2,000 by the weekend. Almost zero. That is not a bad trade. That is years of discipline erased in days. Mike is not rare. Since 2021, millions of crypto coins have stopped trading. More than half the projects launched during the last hype cycle did not survive. Imagine if half the companies in the stock market disappeared in 2 years. When a coin dies, there is no polite email. Liquidity dries up, exchanges delist it. The Discord goes quiet, your balance still shows a number, but you cannot sell without crushing the price yourself. The math hurts, the psychology hurts more, you question your judgment, you delay plans, you stop talking about money at dinner because the cushion is gone. Before ideology, start here. If more than half of last cycle's projects did not survive, what makes you sure yours will? If you are wrong, it is not just a bad trade, it is years of your life. You do not get back. Now consider the math behind those 2 AM refreshes. Bitcoin's annual volatility has hovered around 60% in many periods. The broad US stock market is roughly 15%. That is about 4 times the swings. What does that mean in real life? You invest $20,000. A typical stock market correction of 50% takes you down to around $16,000. Painful, but survivable. Crypto often drops 50%, 60%, even 70%. A 70% drop on $20,000 leaves you with $6,000. To get back to even from a 70% loss, you do not need a 70% gain. You need a 233% gain. That is not a bounce. It is a long climb. Picture it. You check your account and see a giant red candle down 18% in a day. You tell yourself to hold. Next week, it is down another 25%. Your spouse asks if everything is okay. You say yes, but you are calculating how long it would take to rebuild that money from your paycheck. Extreme volatility changes behavior. People panic and sell near the bottom, or they freeze and refuse to rebalance because selling would make the loss feel real. Both reactions lock in damage. This is what extreme volatility does. It turns normal corrections into financial setbacks. Now apply that to your life. If crypto dropped 70% tomorrow, would your housing timeline change? Would retirement move? Would stress enter your relationships? Here's a simple rule. If a 70% drop would change your housing timeline, delay retirement, or strain your relationships, your allocation is too big. For most people, that means 0.5%, not 20%. Size determines survival. Now zoom out. If this volatility stresses you as an investor, imagine running a small business on it. We are told crypto is mainstream, that it is the future of money. Out of roughly 350 million businesses worldwide, only about 18,000 accept Bitcoin directly. That is not widespread adoption. It is a rounding error. Money is plumbing. It has to work quietly and predictably. High volatility makes everyday use impractical. A currency needs stability, so buyers and sellers can plan. If Bitcoin drops 15% in a week, a business either keeps changing prices or absorbs the loss. Most will not take that risk. Picture a coffee shop owner, profit margin 8%. If they accept Bitcoin and it drops 10% before conversion, the entire week's profit can disappear. That is math. So far, one rule matters. Stability drives usage. Speculation drives headlines. If something is mostly held because people hope it rises, not because they need it daily, that gap is where risk lives. Now, revisit Terra, $45 billion erased in a week. If you had $100,000 in its ecosystem chasing that 20% safe yield, you did not lose 10% or 30%. You lost almost everything. Terra was not just a failed project. It showed what extreme leverage looks like when confidence disappears. That 20% safe yield did not come from real profits. It depended on new money flowing in. When that slowed, $45 billion vanished in a week. If your return only works when new buyers show up, that is not stability, it is fragility. The pitch was simple: deposit your money, earn around 20%, sleep well because it is algorithmically stable. Think of a water tank with a leak. As long as water flows in faster than it leaks out, everything looks fine. When inflow's slow, the tank drains fast. Terra's tank drained in days. It did not happen in isolation. When interest rates were near zero, investors searched for yield. If your bank paid 0.5%, a 20% stable return felt hard to ignore. When safe bonds yield 45%, the need to chase double digits falls. Capital rotates, liquidity dries up. Fragile systems crack, strip away the marketing, and you are left with one question: where does the cash come from? If the answer depends on constant growth, you are not earning interest, you are taking liquidity risk. When confidence breaks in a leveraged system, collapse is fast. Now consider trust. If you had money on FTX, it did not matter what Bitcoin was supposed to be. Your balance showed one thing, your withdrawals showed zero. Roughly $8 billion in customer funds were missing. That was not volatility, it was access risk. A major exchange failed because it used customer deposits for risky bets. Customers could not withdraw. Panic spread. Investors began questioning every platform. Trust in finance is like oxygen. You do not notice it when it is there. When it disappears, everything stops. After FTX, prices fell because confidence broke. Capital became more selective. Regulators increased oversight. Institutions slowed. Add Terra, add FTX, add millions of failed projects. You do not just get price swings. You get a reset in how risk is priced. Now consider the cost. Many people miss opportunity cost. If $50,000 sits flat for 3 years, you did not break even. At 9% annual compounding, that could have become about $64,000. Flat is not neutral. It is expensive. That is before inflation reduces purchasing power. Think of every dollar as an employee. If that employee is not producing, it is not resting, it is falling behind while prices rise. Extreme volatility stretches time. Large drawdowns require long recoveries. During that recovery, other assets keep compounding. Now return to allocation. You can believe in Bitcoin long-term and still limit it to 3-5% of your portfolio. Belief and position size are different. Treat crypto like venture capital, high upside, high failure rate. Size it that way. Here is the test. Assume a 70% drop tomorrow. If that loss would change your housing timeline, delay retirement, or add stress at home, your position is too big. For most people, that means 0.5%. Decide your maximum dollar loss first. Then size the position. So a realistic crash does not derail your life. Crypto is not evil, but size determines survival. Ignore that, and you are gambling with money you cannot afford to lose. Respect it, and speculation becomes controlled. Strip away the hype and the cycles. It comes down to one question: can your financial life absorb extreme uncertainty? Not in theory. In practice, speculation promises speed. Stability builds freedom. The question is not whether crypto can go up. It is whether your life can handle it going down. If this makes you rethink your allocation, share it with someone about to put serious money into crypto. Protect your base first, speculate second.